1310 WIBA and Ask the Experts, joined this morning by Chartered Financial Analyst Tom Plumb. Tom comes to us from Wisconsin Capital Management, the website, and I hope you get a chance to head on over there today, wiscap.com. That's WISCAP.com. Again, that's wiscap.com. Tom, how you doing this week?
Oh, we're doing very good, Sean. Stock market's hit a new record. Bond market seems to be stable. What could be better?
Yeah.
In Wisconsin, when we get warm, nice days.
Yeah, we live in great times. Yeah, you got to love the summer month. And real quick, you just recently had a chance to do a little bit of traveling. You were out east, and I know that's one of the things as folks think about, working with a financial planner. One of the things I think a lot of folks would love to do is travel more, and that's one of the cool things. You get to help people do those type of things, don't you?
You know, that's one of the great things about this job. We're helping people with their financial security and their financial dreams, and letting them know that what they can do, what will be a challenge to do, and what things are impossible for them to do. Some of my people, I tell you have enough money to do anything, but you don't have enough money to do everything.
Yeah. Oh, that is funny. That's good to hear. That's great to think about, too, as folks think about, kind of achieving those goals and dreams. And, this week we're going to be talking about the framework when it comes to asset allocation. And one of the approaches, for folks as they approach, retirement and then get into retirement. Let's talk a little bit about that, Tom, kind of how that goes into place at Wisconsin Capital Management, and really thinking about how that allocation starts out as you're getting ready for retirement. And do things change as we kind of move through? Let's kind of get an overview on that, Tom.
Sure. Sean, a lot of wealth managers, financial advisors tell people as you approach retirement, you need to get much more conservative. And I remember last week we talked about the fact that the Social Security Department tells you that if you hit 65 years old, there's a very good chance that you're going to live to 85 if you're a man, or 87 if you're a woman, or that a couple, one of you is going to live to 90 on average. So that's a long period of time, and risk and returns and inflation all change with the time frame.
So we're going to break down each one of those areas. We'll talk risk, return, and inflation. As we kind of break through that, let's obviously get to the first one this morning, Tom, which is, of course, risk. And nothing comes without risk in life, does it?
Oh, that's for sure, Sean. But you do need to differentiate between risk and volatility. Risk is really a permanent loss of your capital, and that can come from obviously some type of investment going bad and going down to zero, or it can come from your timing if you're required to sell something and the market is adverse. So you need to make sure that you're understanding the difference between volatility. In other words, today, if I want to sell something, I might get a different price than if I waited and tried to see what the market would give me over time. Or if you end up with types of investments that imply that they're reducing your risk, but actually they're reducing your volatility, because we look at private equity or insured products, those types of things, even real estate, they actually moderate your volatility, at least your perception of volatility, unless you have to sell it. And then you'll find out if that volatility that you've been avoiding is really hiding risk, because those assets could be worth a lot less than you think.
Tom, I want to ask you about insured products, for example. And I see I'll be watching. One of the nice things about my job is I have some daytime, free time. So I get a chance to kind of turn on the tube, and I'll be watching some of the game shows and other things, kind of a guilty pleasure. I'll see commercials pop up with things like some of these insured products. And I think sometimes you watch them and you're like, oh, well, that sounds really, really nice. It's like I've got my own, almost like my own pension. What are some of the things folks need to maybe understand a little bit more when it comes to that type of product?
Well, Sean, I think the main thing that they need to understand is the financial structure of the product. So if you, for example, are guaranteed a certain rate of return, but then you need the money before the maturity date, there could be substantial penalties. A lot of them hide what their commission structure is by actually taking it out of their expense ratio for a number of years. But then if you want to sell it before that expense structure is amortized, you could really get hit.
Talking this morning with Tom Plumb, Chartered Financial Analyst with Wisconsin Capital Management. You can learn more about Tom and the team all on the website, WisCap.com. That's Wiz, WISCAP.com, WisCap.com. Talking this week about some things to address, important things when it comes to asset allocation. We're talking risk, return, time, and inflation. And, of course, as we're working our way through risk, real estate. And I know real estate is something some people are very, very heavy on. There are some warnings and some things to think about in that area. And I know in one of the notes you had mentioned some Florida real estate, just as a bit of an example, Tom.
Yeah, exactly. So real estate, like other operating entities, if you have an income coming from it, then you can feel somewhat comfortable that you may have some protection in your asset value. But if you own real estate that's adversely impacted, for example, by hurricanes in Florida, as I'm well aware, that real estate could be worth a lot less than you thought it was just because of the inclinations of people. If you own real estate in farmland in northern Wisconsin, for example, you may go years and years and even decades before you could actually make a profit on that property. So real estate is location, 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 and it's whether or not you have a carrying cost or if you have a positive cash flow from it.
Really,
just other enterprises.
It's interesting you say that. One of the things I've got to witness over the years is seeing, a lot of, where I am down here in Rock County is there's a lot of farmland, and I've seen a lot of farmers find ways or hope to find ways to maybe sell that off to developers and others. And some of them I've known for 15, 20 years now still are sitting with that farmland that in some years they're not doing any work on it. So kind of having that understanding of kind of those markets is really important. I got to ask you too, you started this part of this conversation talking about the difference between volatility and risk, and when can volatility become a risk, Tom?
Again, volatility can become a risk when it's a fundamental issue because something is actually going down in perceived and actual economic value. And it can become a significant risk when you have to sell in adverse markets. So real estate may have been a great investment over a long period of time. And for example, Florida real estate can be a great investment over a long period of time. But I know that on some of the barrier islands in Florida right now, they're trading 20 to 30% less than they were 2 years ago. So again, if you have the ability to go through that cycle, you may say, well, it was a volatile time. But if you needed the cash or you needed to sell, that's real risk.
Talking this morning with Tom Plumb with Wisconsin Capital Management, the website WisCap.com. That's WISCAP.com. Of course, Tom is a chartered financial analyst with Wisconsin Capital Management. Hope you get a chance to head on over to the website, learn more about Tom and the team and a little bit about them, and a chance to make an appointment as well. That website again, WisCap.com. That's WISCAP.com. Let's dig into that second part then Tom. Let's get to I think this is the fun part to talk about, the return part. Let's get into that a little bit.
Well, over time, you can see what returns have been, and it depends again on your measurement time period, when you start, where you finish. If I, for example, were to buy a 4% CD, for example, that was going to mature in 1 year, I can tell you what my return is going to be in that 1 year, but I can't tell you what my expected return is going to be for the rest of my lifetime. Historically, we can tell you that common stocks measured by the S&P 500 have had an average return of almost 10% or 6.5% after inflation. But no one can tell you what that return is going to be next year or even beyond in the future. Today, the United States Treasury will pay you almost 5% for the next 30 years. And historically, bonds have averaged like that, 4 to 5%. And basically 1 to 3% over inflation. So real estate, as we've said, depends on where and what, but a lot of private equity in real estate has matched and sometimes exceeded the return of the average stock. But it's again, operating companies have a better chance of maintaining their value than just taking some type of a fixed contract.
And Tom, what about the liquidity of real estate? Obviously it's, I think for a lot of folks, investment properties and others, probably not the worst thing to have available. But if it comes time to sell, you're kind of at the mercy of the market there, aren't you?
Oh, yes, you are, Sean. And of course, you have commissions that may be involved, and you have the length of time that it's going to take. Again, just looking at barrier islands in Florida, on average, they're sitting there almost 400 days before they're being sold. So that's a lot of time if you needed the money for something.
Talking this morning with Tom Plumb, of course, chartered financial analyst. Of course, Tom comes to us from Wisconsin Capital Management. You can get to know Tom. You can get to know Nathan as well, the whole team at Wisconsin Capital Management on their website, wizcap.com. That's WISCAP.com. That's wizcap.com. Hope you get a chance to head on over to the website this morning when you get into the office, or maybe you're listening to the podcast. You can always head on over to wizcap.com to learn more. We're going to continue our conversation with Tom. We're going to talk about that final piece, which is two parts, which is time and inflation. We're going to put those together. We'll wrap up our conversation with Tom Plumb of Wisconsin Capital Management. We'll do that next as Ask the Experts continues right here on 1310 WIBA. 1310 WIBA and Ask the Experts, talking this morning with Tom Plumb. Of course, Tom comes to us from Wisconsin Capital Management, the website, wizcap.com. That's wizcap.com. And Tom, I love the website. It's funny because I always want to be like wisconsincapitalmanagement.com. That's a long thing to type in. WizCap is super, super convenient, WISCAP.com. And before we get into time and inflation, let's talk a little bit about getting to know you. And for folks that have been listening to the program, have enjoyed what you've had to say, want to learn more, the website's a pretty good starting point, isn't it?
It is a starting point, but a conversation really can help you get to where you need to be in talking to us about your specific personal situation. So we'd like you to get some idea of who we are, where we are, but Nathan and I can sit down with you, talk about your personal situation, and apply the investment advice and investment expertise that we have to you individually.
And Tom, that's one of the big things. You use that word personal, and I think that for a lot of folks, that's important. We spend our lives, working very, very hard. We build a little nest egg, and we really want the best for it. We want to see it grow. The one thing I think that makes us feel better is having somebody that we have a personal relationship with, that we have an understanding of personalities and goals and how everything meets. And that I think I mentioned this on a previous show. I remember the first day you and I sat down and we're just kind of talking about Wisconsin Capital Management, and I was getting to know you, and right away I could tell there is I don't know if it's a je ne sais quoi or what the kids would call it these days, but there is a real passion that's very apparent early on with that, and having that personalized touch is really important to folks, isn't it, Tom?
Oh, it is, and someone has to really take pleasure in your success,
yeah.
And that's what makes us feel like every day we come into the office, we're very excited that we're helping somebody reach their financial success, their financial serenity, by having a plan and an asset allocation that works for them.
It's really great stuff as we talk this morning with Tom Plumb of Wisconsin Capital Management. Make it personal. He'd love to get to know you. You can get to know Tom and Nathan and the whole team at Wisconsin Capital Management. Again, just head on over to the website, wizcap.com. You can set up an appointment, start that actual person-to-person conversation. Great place to start is learning more at wizcap.com. That's WISCAP.com. So we talked about risk, we talked about return, and then the third point for this week, and it's an important one, which is time and inflation. So let's kind of break down. You mentioned some of the numbers and some of the statistics for life expectancies and others. The time and inflation can both, obviously, one can work for you, one can work against you, and you really want to be managing these forces, don't you, Tom?
Exactly, Sean. When you think about it, inflation is real. When I moved to Madison, Wisconsin in 1980, the consumer price index was at 80. Now it's at 321.
Wow.
So that means that 4 times the cost to find and purchase the exact same things I bought 45 years ago. It's to protect against inflation is one of the significant long-term goals that every one of our clients have. And you need to think about inflation. It may not sound like much when we're talking about, oh, are we at 2% or 2.5%? But I can tell you that over time, that erodes your purchasing power, and you need to be able to come in and address that with a portion of your assets, those portions that are meant to support you in the long term.
What about I hear a lot of folks talking about gold, the virtues of gold, and other things. What's kind of your take on having gold in your portfolio, Tom?
Well, what we call real assets or hard assets like gold are often highlighted as being an inflation hedge. And gold has had a really nice run over the last 2 years. So it's basically doubled. And by doubling, it's now 3,300. But in 1980, when I moved to Madison, Wisconsin, January of 1980, gold hit $800.
Oh.
So in other words, it had to double in the last 2 years to be an inflation hedge to match the consumer price index.
That's it. That is that's a little eye opening. I when you frame it that way, you start to realize that is a very, very fascinating. As we talked this morning with Tom Plumb of Wisconsin Capital Management. Again, the website wiscap.com. That's WISCAP.com. So kind of breaking that down a little bit more as we go through through some of these numbers, and of course we talk about inflation and time. Let's talk about then we kind of apply time in the S&P 500. Where do those numbers and kind of we go through time? What's the trajectory there look like, Tom?
Well, again, Sean, just going back to these 45 years, the S&P 500, which is the major U.S. stocks index, was at 127 back in January of 1980. It's over 6,300 right now, or up almost or nearly 50 times.
Wow.
And it's paid a modest dividend at that time. So when you think about it, high quality operating companies have been a very good long-term protection against inflation erosion of your purchasing power. The companies that generate positive cash flow, high quality companies, you can always lose money on an individual stock, and there's many stocks over that 45 years that have gone by the wayside. But in general, good quality operating companies have come to the top just like cream. And that has allowed the average person to have significant protection against the erosion of purchasing power that inflation has.
Let's talk.
Go
ahead.
Oh, I'm sorry. So Nate and I, what we like to think of is you have to have a portfolio strategy that has basically buckets.
Okay.
You need to have that liquidity for those types of expenses you're going to have over the next 18 months to 2 years. Because nobody can tell you that the stock market is going to be up, or even that what the interest rates are going to be 2 or 3 years from now. Then you have the intermediate term, where you should probably consider 2 to 7 years, where you know that you want to have some growth because inflation is significant, but it won't erode you that much in that period of time. And you need a bucket that probably has some more balance to it. But then as you go towards your longer term, how you're going to protect your family, yourself from the ravages of inflation, there you probably need to have some type of an equity. We've been happy with the publicly traded equities that have rose to the top here. And we spend a lot of our time analyzing those companies to make sure that we have the right ones for our clients.
And Tom, I'm going to take a guess here. When you break down those three areas, I'm guessing that it's not equally split across the three. That you really want to fine tune percentages of what, as far as your investments, looking towards short term, mid term, and long term. And that's a real art to formulate that. And then of course breaking down inside of all of those buckets what you actually have in those to achieve those goals. Is that really the role?
Exactly true, Sean. And in fact, we talked about a little bit last year. Last week. I'm sorry. If that's what buckets are determined by what your actual expenses are, and you need to have some real honest analysis of what you're going to spend your money on, what you are spending your money on, and what you will be spending your money on in the future. And that is one of the key determinants for how much money has to be in each one of those buckets.
Talking this morning with Tom Plumb, chartered financial analyst with Wisconsin Capital Management. Head on over to the website this morning, whizcap.com. That's WISCAP.com, whizcap.com. Don't forget, you can listen back to this and previous shows' podcasts also on the website, whizcap.com, also on our website, WIBA.com. It's always informative talking with Tom. Again, you can learn more at the website, whizcap.com. Tom, it's always fantastic to see you. You enjoy this great day, and we'll do it all again in 1 week.
You bet, Sean, and you have a great morning.
You do the same. News comes your way next right here on 1310 WIBA.